India's most valuable startup, Byju's, is laying off nearly 2,500 or 5% of its employees as part of its optimization plan. Other startups have also cut their headcounts in 2022. Blinkit laid off 1,600 employees, Unacademy 1,000, and Vedantu over 700. The layoffs are believed to be the result of a global funding slowdown that has also hit Indian startups this year, forcing them to conserve cash and discipline themselves. The slowdown has been more pronounced in India. Analysis by CB Insights showed that in the third quarter of calendar year 2022, India's share of total venture capital funding that went to Asia fell by nearly half to 14%, compared to 22% in the second quarter. During the same period, China's share went up from 34% in the second quarter to 42% in the third, even though overall VC funding shrank in Asia. China's share also rose despite Beijing's crackdown on tech companies and apprehensions among PE funds. Total venture capital funding in Asia stood at $20.1 billion in the third quarter, down from $29.8 billion in the second. Quarter on quarter, global VC funding and that of the Asian market declined 34% and 33% respectively. However, Indian venture capital funding fell more steeply. VC funding in India crashed to a 10-quarter low in the third quarter of calendar year 2022 at just $2.8 billion across 387 deals. This was a 58% decline compared to the $6.6 billion in VC funding across 404 deals in the previous quarter. The third quarter numbers also represented the lowest level since the second quarter of calendar year 2020, when the COVID-19 pandemic hit the global economy. On a year-on-year basis, the third quarter decline was even sharper, with Indian VC funding at less than one-third of the $9.8 billion clocked last year. Reports indicate the unicorn rush is also slowing down. According to venture intelligence data, India minted 21 new unicorns in the first 9 months of calendar year 2022, compared to 30 during the corresponding period for 2021. Startups valued at $1 billion or more are popularly known as unicorns. But what are the factors spoiling the party for startups, particularly in India? Traction co-founder Neha Singh points to global macroeconomic conditions, particularly the fears of a global recession, as a reason behind the slowdown. According to Singh, the funding slowdown in India is expected to continue for the next 12 to 18 months, and its effects are expected to intensify going forward. And why is the slowdown particularly pronounced in India? In his column for Business Standard, Ajay Shah, a researcher at XKDR Forum, may have highlighted the reasons even before the recent numbers came out. Shah explained that while the Indian VCs and PEs had great success with several IPOs, many of the richly priced ones fared poorly after the listing date. This has not only made it harder for others to list at rich valuations, but it is also feeding back into the funding environment at earlier stages. Shah also pointed to the changing financing conditions worldwide. According to him, the rate hikes in developed markets have triggered a retreat of global capital from risky and illiquid assets in favor of developed market assets, causing turmoil in exotic assets such as startups.
When the US gets a fever, the entire world catches a cold. And I think a lot of the funds that Indian startups were raising was mostly from venture capitalists and LPs in the US. Between, let's say, 2014 to 2017-18 or pre-COVID times, a lot of the funds were raised in models which were completely experimental. Angel investors got hooked onto the idea that as long as they're investing in a large market and pedigreed sort of entrepreneurs, they will have their valuations, go up the moment venture capitalists come in. And there was no way for a venture capitalist to not participate because the risk of losing out was just way too high. And of course, the valuation game sort of started, playing out to an extent that it's now come to a point that the confidence is too low because the companies that did get valued at very high amounts did not really perform as well as they should have when they IPO'd and went into the public markets.
According to PwC India's Q3 CY22 startup report, while the decline in funding was noted across all stages, early stage deals were the least affected. PwC's India Startups leader Amit Nauka believes early stage startups would be able to raise capital more easily as they were typically more insulated than late stage deals from fluctuations in the public markets. So, the important questions are who will be the worst hit and which type of startups will prove to be relatively resilient.
If the startup is at a life cycle where they still need further a lot more funding before the unit profitability is proven, you are likely to see that funding cuts down there. I think that's what would have happened here. Also, I believe that a lot of funding will tend to move towards where consumptions are likely to be more. So, for example, B2B or funding for B2B companies, B2B startups, technology deep startups, rather than consumer spending related businesses.
The slowdown is here to stay and will separate the wheat from the chaff. Those who have been chasing high valuations and market share at the cost of profitability and a viable business model will have to mend their ways or perish.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.